In our forecast, we have the first cut coming when core PCE inflation falls below 3 year-on-year, below 2.5 month-on-month annualized. So that's roughly the threshold I have in mind. I don't think we need to get all the way back to 2.0, but I do think they'll want to have quite strong evidence. We don't expect to get there until the spring of next year.
What's that going to do to the economy, though, David, if we're holding at high rates until Q2 of next year?
Our analysis basically says that the impact of the monetary policy tightening we've had so far is largely behind us, that the tightening in financial conditions we've had to date had basically happened by the first half of 2022. That's a long time ago at this point. And that even accounting for the lags of the impact of monetary policy tightening and financial conditions broadly tightening on GDP growth, the peak effect of all of this came in the back half of last year. And by the back half of this year, where we are now, I think that effect has largely faded. The same is true of fiscal policy. We had a very large fiscal tightening that restrained demand growth last year. That looks much more modest at this point as well. I think that's probably the big part, a big part of the reason why we have seen the economy demand reaccelerate a little bit this year. And that's not ideal. The plan was to continue to rebalance supply and demand a little bit further. That requires below potential growth. So far this year, that's not where we've been.
David, let's talk about sort of the elephants in the room, and which could challenge this outlook or forecast of yours, and that is, one, whether or not another medium-sized lender, bank or regional bank, is going to blow up, one, and two, over in Ukraine, if things start going wrong, not just oil, but also on the food front.
I think we're probably past the peak risk from commodity prices rising. I would think at this point of a rise in energy and food prices as a setback for the inflation story, but not a game changer. For 20 years prior to the pandemic, we had at times substantial fluctuations in energy prices. They did not really leave a lasting imprint on core inflation or inflation expectations because inflation expectations were sufficiently well anchored. I think what happened in 2021 and 2022 was fairly special in the sense that so many commodity prices rose so sharply, and at the exact same time that shortages were pushing up prices fairly dramatically on other items. That did create a somewhat dangerous situation where, we worried a little bit about inflation psychology becoming unanchored. But that was really a special set of circumstances where so many things were going wrong in a very big way at the same time. If we now see an increase in oil and food prices that's more moderate than we saw when the global economy was reopening, and we see that more in isolation, sure, that will add a few tenths to core inflation. That will make it harder to get back to that 2 to 2.5 range. But I don't think it would be unnerving the way that it was in the first half of 2022.